Welcome to the deep dive. We are jumping straight into the numbers today, offering you a professional summary of one of the most, significant earnings calls this quarter.
That's right.
We are unpacking the Q3 2025 results and strategic update from Riot Platforms. And this event, it felt far less about just past performance, didn't it? More about a fundamental repositioning.
Exactly. This deep dive is really about a company trying to fundamentally change how the market sees it, how it's valued.
Right.
This call, held after the market closed on October 30th, it provided the financial muscle they needed to justify that shift.
Okay, so let's hit those headlines then. We saw a clear beat on the top line.
We did. Revenue came in strong at $180.2 million.
Wow.
That not only beat analyst consensus by a healthy margin, $8-12 million, somewhere in that range, but it also represents a huge 112% increase year over year.
That's exceptional growth. Just massive.
It really is, no matter how you slice it.
And then the bottom line, that provided maybe the biggest surprise, GAAP EPS landed at $0.26 per share.
Yeah, $0.26. That's a decisive swing into profitability.
Comfortably beat estimates too, right? Some were even predicting slightly negative earnings.
Oh yeah, it beat them comfortably. It's a powerful result on the surface, but here's where we need to add some important context for you, the listener.
Okay.
The company reported adjusted EBITDA of $197.2 million. Now that looks phenomenal.
Sounds great.
But you must immediately, mentally subtract one crucial component. It included a substantial $133.1 million unrealized mark-to-market gain on their Bitcoin holdings.
Wait, $133 million out of $197 million. That's like, what, 2/3 of the reported EBITDA?
Pretty much, yeah.
So if we strip away the noise of rising Bitcoin prices and just focus on the operational results, what was the true profit quality there?
You've hit the nail on the head. That gain, while it's real on the balance sheet, sure, it's non-cash. It's entirely based on the change in the value of the Bitcoin they hold.
Right, not from actually doing business.
Exactly. It's not indicative of the actual repeatable cash flow generation or like the run rate profitability from mining and services.
Okay.
So for investors looking at future performance, it's the underlying operational strength that really matters.
Makes sense.
And that operational strength, that's what's funding the big pivot we're about to discuss.
Right. Which brings us neatly to the core theme. The CEO was, pretty unequivocal. Riot is moving from being just a pure play Bitcoin miner to becoming a large-scale, multifaceted data center enterprise. That sounds like more than just rebranding.
Oh, it absolutely is. It's capital allocation shift. The shift is happening, and Q3 provided the concrete evidence.
How so?
They're really focused now on monetizing their huge pre-approved power capacity. They're basically taking their mining know-how, all that experience, managing power and infrastructure, and applying it to the hyperscaler and enterprise data center space, which, tends to get much higher valuation multiples from the market.
Right, that's the goal. So the major news came from Corsicana, Texas. They announced the initiation of core and shell development. Can you define that for us, and what scale are they starting with?
Sure. So core and shell basically means they're building the main structure, the walls, the roof, the basic power infrastructure, getting it ready for a tenant to come in and customize the inside.
Okay, like the skeleton.
Exactly. And they initiated this for the first 2 buildings at the Corsicana campus. That represents 112 megawatts, or MW, of critical IT data center capacity right off the bat.
112 milliW. That sounds like a pretty long runway, though. What's the actual timeline for delivering that capacity to a tenant? When could someone move in?
Well, construction mobilized in Q1 2026. So just getting started. The first building is expected to be completed, ready for tenant handover, in Q1 2027.
Q1 2027.
Got it. And critically, alongside this, they also finalized the land acquisition. They bought another 67 adjacent acres. That finalizes the land needed to support the full 1 gigawatt of approved power capacity they have at Corsicana. So they've secured the power, and now they've secured the entire physical footprint for all of it.
That full gigawatt scale is pretty impressive. They also talked about design standardization. Why is having a standardized basis of design so important, especially for attracting those massive tenants, the hyperscalers?
Yeah, it's huge. Because predictability is absolutely king when you're talking about these multi-billion-dollar compute build-outs. Hyperscalers need to know exactly what they're getting and when.
Makes sense.
So Riot completed a standardized Tier 3 resiliency design. Now, for the non-technical listener, Tier 3 basically means the data center is guaranteed to be concurrently maintainable, meaning you can do maintenance on parts of it without shutting the whole thing down. Maximum uptime, that's like table stakes for large customers.
Okay.
And this design, importantly, is replicable. They can use the same blueprint at their other massive site, Rockdale.
Ah, so it's modular, repeatable. That leads into their 7-mod format you mentioned. Break that down. What does this standardized unit actually look like?
Think of it like their construction Lego block, basically.
Yeah.
The overall design is flexible. It can be single, 2, or even 3 stories high.
Okay.
But the core capacity block is this 7-mod format. Each of these standardized data halls represents 14 milliW of critical IT load.
7 mods, 14 millidues each.
Yeah. This lets them scale quickly, promise very predictable capacity increments, and this is key. It can accelerate the procurement of long lead equipment because they know exactly what they need over and over.
Right. That predictability helps with supply chains. Okay, so we've established the strategy as data centers, but the engine funding this whole thing, that's still the mining business, right?
Absolutely.
How healthy is that engine? Especially when the global hash rate keeps climbing, making it harder to mine.
The mining operation is still highly efficient. They produced 1,406 BTC during the quarter. And yeah, despite the global hash rate jumping 8% just quarter over quarter, which makes it tougher for everyone to get rewards, Riot managed to maintain its low-cost position.
What were their costs like?
Their cost to mine, if you exclude depreciation and amortization, was only $46,324 per Bitcoin. Pretty low.
And their unique power strategy that helps subsidize those low costs, doesn't it?
It absolutely does. It's a huge advantage. Their ability to sometimes curtail mining operations, basically shut down the miners and sell that power back to the grid.
Yeah.
That generated $31 million in power credits just in Q3.
31 million.
Yeah. And that success drove their net cost of power down to an outstanding 3.2 cents per kilowatt hour.
Wow.
So this ability to monetize power, even when they're not mining, that gives them enormous flexibility and, crucially, the cash flow to fund this capital-intensive data center build-out.
Okay, let's talk about something that really seems to separate Riot from, well, almost every other data center developer out there, their vertical integration, specifically through their engineering arms, ESS, Metron, and E4A solutions.
They generated $19.1 million in engineering revenue, which is nice, but what's the strategic value there?
This is like their operational moat. It's a huge differentiator.
How so?
This vertical integration gives Riot direct control over the supply chain for those critical, long lead time items, things like low and medium voltage switchgear.
Okay. And that's hard to get right now.
Extremely hard. This equipment is probably the most constrained component in the data center industry right now. Wall Street analysts keep highlighting it. It can take other developers, 18, maybe even 24 months just to source this stuff.
Whoa. So if every other data center builder is stuck waiting for the same switchgear and Riot basically owns the factory making it, they can guarantee delivery schedules to tenants that competitors just can't match.
Precisely. That's exactly it. It's like owning the tire factory during a car boom.
Yeah.
Certainty of delivery, schedule certainty, that is paramount to a hyperscaler planning a massive deployment.
That makes perfect sense. And there's a huge financial benefit too. Riot mentioned they've already realized $23 million in cumulative CapEx savings on equipment purchases just since they acquired ESS Metron.
So they build faster and cheaper.
Because they own the choke point in the supply chain. Yeah.
That synergy is, hard to overstate. Okay, before we move to valuation, what about SG&A discipline? Selling, general, and administrative costs, are they getting bloated as they grow?
Actually, the opposite, which is impressive. While their total revenue grew over 110% year over year, which is massive.
Right.
Total SG&A remained relatively flat over the past year.
Really? Flat?
Yeah. That demonstrates significant operating leverage and real economies of scale kicking in. They're building this massive operation without ballooning the administrative overhead. That's crucial for staying profitable during this big transition phase.
Okay, great point. So now for the investor, so what? The whole thesis here really hinges on the idea that the company shouldn't just trade based on the whims of Bitcoin's price anymore. Management is betting big on this multiple re-rating thesis. What's the foundation of their argument? Why should the market value them differently?
The foundation is really two things: scale and location. First, scale. Riot claims to have one of the largest power portfolios in North America. We're talking more than 1.8 gigawatts of fully approved and available utility load.
1.8 gigawatts. That's enormous. And it's approved, ready to go.
That's what they're saying. This isn't theoretical power they hope to get someday. It's secured utility load.
Okay, and location.
And location. About 1.7 gigawatts of that capacity is strategically located in arguably the most desirable data center markets in the U.S. right now. Dallas, with the Corsicana site, and Austin, with the Rockdale site.
Right, major tech hubs with lots of fiber infrastructure already.
Exactly. Hyperscalers need power where they can readily connect to existing networks and talent pools. These are premier locations.
Let's quickly circle back to the Corsicana phasing you touched on earlier. This seems key to how the operational financing meets the strategic goal. Why build the data centers in 2 phases there?
Right. It's about maximizing the value of every single megawatt they have. Phase 1, which is the 504 milliW they're starting now, uses adjacent land that's currently unused.
Okay.
This allows the existing Bitcoin mining data centers already on that site to keep running, keep generating cash flow.
Funding the build-out.
Exactly. Funding the build-out of the new higher value data centers.
Yeah.
Then phase 2, which is another 168 milliW, will eventually supplant those existing mining centers.
Replace them.
Allowing Riot to eventually flip the entire 1 gigawatt site over to high margin data center capacity. It's a smart way to self-fund the transition.
Okay, that makes a lot of sense. So if we connect this to the bigger picture, management explicitly stated they anticipate moving away from that minor beta valuation. For the listener, what does that mean practically? What are they trying to escape?
It means escaping being a stock that primarily just tracks the daily ups and downs of Bitcoin's price and maybe the global hash rate. That's the minor beta, high volatility tied to the crypto market.
Right.
They want to transition to trading like high growth infrastructure peers. Companies valued on recurring revenue streams from long-term leases, predictable asset value, much lower volatility. Think data center REITs or infrastructure companies. Got it. And Rockdale, the other big site.
Yeah, the 700 milliW Rockdale site, that provides massive future optionality. It's the next logical step for data center development after they fill up Corsicana. For now, it's a valuable cash flow engine churning out Bitcoin.
So what are the immediate signposts? What should we and you, the listener, be watching for in the next, say, 12 to 18 months that would tell us this thesis is actually playing out?
Well, construction milestones are huge, obviously, seeing those Corsicana buildings go up on schedule.
Sure.
But the biggest catalyst, the one everyone will be watching for, is updates on tenant leasing discussions, specifically high-quality tenants.
Meaning the hyperscalers. Or major enterprise customers. Yeah. Management must land one of those big fish for Corsicana. Those kinds of announcements, combined with the continued strong mining cash flow reports each month, those are the key near-term catalysts.
Right. Let's turn to our favorite speculative segment. This is not financial advice. Given everything we've discussed, what highly leveraged yet maybe plausible trade idea emerges from all this data?
Okay, so the thesis is pretty simple.
Yeah.
The market is fundamentally mispricing the certainty Riot potentially offers. It's still too focused on the crypto mining identity.
Right, the old story.
And it's ignoring the sheer scale of that 1.8 GW power portfolio and, crucially, the timeline guarantee potentially afforded by their vertical integration. That ESS Metron ownership is key.
So the stock's trading on minor beta.
While management is executing on what could be data center infrastructure alpha, there's a disconnect.
Okay, so how do we structure a trade around that potential certainty, that disconnect?
Well, one idea, again, not advice, is maybe a long-dated, deep-in-the-money call spread on Riot Platforms.
Going long. Why deep in the money?
You're betting more purely on the multiple re-rating, less on just the stock price going up a bit. You want that structural shift in valuation.
Okay.
But, crypto is still volatile, so maybe you hedge out some of that residual crypto risk. You could combine that long spread with, say, a small short position against a pure play Bitcoin mining peer.
Someone without the diversification.
Exactly. Someone who is just a miner, maybe single site, definitely someone who lacks that scale and, importantly, lacks the vertical integration for building infrastructure.
So you're trying to isolate the infrastructure value proposition of Riot.
Precisely. You're capturing the potential, maybe it's a 2 or 3-fold multiple re-rating if management lands that big tier 3 hyperscaler tenant sometime in 2026.
Which they might be able to do because of the construction certainty.
That's the bet, that the construction certainty from vertical integration is the key selling point. And you're hedging out some of the noise from just Bitcoin's price bouncing around. It's really a bet on capital allocation prowess and execution.
Fascinating analysis. Okay, to quickly summarize this deep dive then. Riot Platforms delivered a substantial Q3 revenue and operational beat. That highly profitable mining engine is still humming, crucially funding the transformation. They formally initiated their big strategic pivot by breaking ground on the first phase of the potential 1 GW Corsicana data center site.
Yep, 112 million to start.
Leveraging their enormous 1.8 GW power portfolio, most of which is sitting right in those premier Dallas and Austin markets.
Two locations, yeah.
And that vertical integration gives them a potential edge in delivery certainty.
Which brings us to the final thought. The critical point for you, the listener, to consider is this. The demand for compute capacity, for AI, for everything, it seems insatiable, right? But the real bottleneck isn't capital anymore. It's power availability and, maybe even more importantly, certainty of delivery. When can you actually get that capacity online? So the question for you is, can Riot, with its massive, already approved power portfolio and its self-owned supply chain for critical gear, actually achieve the delivery certainty that hyperscalers are desperately demanding right now? And if they can, how quickly will the market wake up and close that valuation gap between miner and infrastructure provider?
That's a powerful thought to leave you with indeed. Thank you for joining us for this analysis of the Riot Platforms earnings call. Remember, this deep dive is strictly for informational purposes only.
Definitely not financial advice.
So I'll catch you next time.